Hey, everybody. Welcome to Coach's Playbook. Jack's not here, but we got the Dancing Bear. As always, we got Mick and Hogue. Today, I'm actually excited about this topic. I saw it recently in our Facebook community. So if you're not a member of it, topsteptrader.com/Facebook or topstep.com/Facebook. We are a new brand. No more green. We are black and white. It's pretty exciting. But I saw a comment in there talking about using stops. And we talked about this a little bit last week. It came up. We figured it's a great topic to talk about today. But before we dive into that, Mick, we got any funded traders putting up some numbers today?
We've got several of them. I'm watching Asha Sharma right now, up about 3,300 trading the S&Ps today.
Woo.
So it's a nice day for you. Good Tuesday.
Obviously long.
Right. Can't make much money short right now. So Mick, I want to kick it to you first, because the question I saw was a trader was kind of talking about the funded trader agreement and the question about having stops when they're in their positions. Mick, I know you love stops. So can you talk about that a little bit?
Sure. I'm happy we're talking about stops, because last week when we were talking about gaps, we started to predominantly speak about stops. Kind of an interesting thing. As far as the comments or questions you were receiving about funded accounts, yes, we require all traders in a funded account to have stop on any open position. It's good practice. We don't say your stop needs to be 5 or 10 ticks away from where you put the position on, but you should have a stop in. It's a fail-safe stop market orders, which guarantee that you get out of a position. They don't guarantee where you get out of that position. There could be slippage because it is a market order, but this is something that all traders should be using. I understand that can become a little bit more complicated if you're a point and click trader who's trading on a very short time frame, in and out, long and short. Requiring to have stops on these open positions, it doesn't mean you need to use a bracket order every time you put a trade on. Within reason, if you go long, you should have a stop order that you put in sometime within a reasonable amount of time after you initiate a trade. Anytime we take risk, we should know where we're getting out if we're wrong, where we're getting out if we're right, and where you're wrong, you should have a stop there.
Absolutely spot. I'm always the quote guy, and I thought of a quote today when talking about this, and a lot of famous quotes talk about, well, it's only failure if you let it keep you down, and this idea of like failing to continue to learn new things. And in trading, I think that kind of adds like having that, you've got to kind of fail to kind of learn. But having a stop in avoids a stupid mistake everyone can avoid. That stop in there is what Mick said, total fail safe.
Definitely. And more so than a fail safe, I mean, when you're in the mindset of, I put a trade on, I need to have a protective stop in, I mean, that's part of framing out a trade. Like I said, know where you're getting out if you're wrong, know where you're getting out if you're right, if it gets to a certain level. You have to frame these trades out. Having a stop in place and having, a predetermined idea of where you're getting out of a trade. If the trade doesn't work, we all know we're going to be in positions where the trade doesn't work, it goes against us, hits a level we think we need to get out at because it could keep going further against us. It puts us in a good position, and it puts you in a position where you're much less likely to get emotional about a trade. If I place a stop in when I take the trade, I'm in a sound mind. I had a good reason for why I placed it where I did. It's there. If it gets tagged, the trade's over with and I can move on. Maybe I move on and put the trade back on in another place, but you don't want to be in a position where, a trade goes against you and you say, ooh, this doesn't look good. What do I do? What do I do? I hope it turns around. All these emotional feelings that come through you make it clear cut, and it makes it that much easier to move on to the next one and find another opportunity. Don't be in the habit of moving your stops either. Oh, it's getting close, I'm going to move it 5 ticks away. I'm going to move it 5 ticks away. It defeats the whole purpose.
Usually your first stop is the best stop.
Yeah.
So, Hook, I got a question for you, because a lot of traders are in and out quite a bit, and they're trying to do a lot of things. When you go back to days in the S&P pit, you guys are pretty active. I mean, you're not sitting there. You're when the trade comes into the pit, you got to be going pretty quickly. how were you able to manage it? And were you using stops? How'd you guys go about it back in the glory days of the S&P futures pit?
Well, back in the glory days, if you were a local trader, you always had the opportunity, if you were going to hold on to something for a longer period of time, to just, tell a broker, hey, if it gets up to 80, buy me one on a stop. There was always that possibility. But in the trading pit, most people were kind of managing their own risk. So we kind of had mental stops, which, as Mick says, it tends to make you move your stops further away, which is never a good idea. The first out is usually the best out with that regard. And I had to laugh at the beginning when you said that Mick loves stops. Nobody likes stops. Well, we like them to protect ourselves, but we don't like them to get hit. So it was a bit of a different game for the locals in the S&Ps. Back in the day, you couldn't just like place an order with a broker and have him automatically execute it if it gets there. The one thing I do want to say about stops is, a lot of folks that I talked to initially in performance coaching, and one of the things, that came up in group coaching last Wednesday after last week's discussion that Mick had started about stops was, what's a good stop level? How far away do you put your stops? And I'm not a fan of a static stop level, like I'm only going to risk 5 ticks per trade. And I'm not a fan of placing stops financially, like I only want to lose $100 on any given trade that I take. Stops should be placed technically at a point of invalidation for the trade. You buy the market here. If price gets down to here, it's probably invalidating the trade and I need to get out. That's where I'm going to put my stop.
Yeah, I think, a lot of people do have that dollar value mentality within their stops. And the one thing I say to that is, if that's really going to be your issue, if you really have to stick to a certain dollar, you have to actually adjust your entry point. Then you have to start looking, okay, I'm going to have to place the stop first at that point of invalidation John's talking about.
Mm-hmm.
And then for this trade to actually work for me, I have to get my entry point closer to that stop so that I can still place a smart trade.
Yeah, exactly. It's about placing your trade location based on the point of invalidation for the trade. Again, we all have different risk appetites. So if you're looking at a trade that's, where the stop's going to be 20 ticks away, that might be more than you're willing to risk. But if you move your stop closer, you're actually kind of getting out of the trade where you should really get into the trade. So look at your point of invalidation, look at where the entry makes you comfortable with the risk, try and catch that entry. The market's going to give you that opportunity from time to time. You may miss a few trades, but I find it's better to get the good trade location and a good stop, than to get in too early, move my stop up, get stopped out of the trade, and then miss the trade anyways. It's like getting smacked in the head twice.
All right, JD, stocks are moving higher. You're the dancing bear. Where's your stop today? Did you get stopped out?
Well, if you're selling new highs, you're definitely getting stopped out. And if you're selling new highs, keep those stops super tight because we are in a melt up right now. So be careful. I'm going to agree with everything that Hoke said too. Where you're placing your stop, it really depends on your pain tolerance. Is the reward worth the risk? If you're trading on a certain percentage of your account every day and your stop levels exceed that, what you're willing to risk in a day, you got to reevaluate and move on to another trade. And also, like I said, is the reward worth that risk? If you're going to risk, 25 ticks on a trade, is the potential reward there for you? There's a lot of things to keep in mind. And also, where are you placing these stops? Other things to look at, like Hoke said, points of invalidation. A lot of people use moving averages to get out former support and resistance levels, which I'm not so huge of a fan of. I mean, if you have 100 traders all looking at the same chart, chances are a significant number of those traders are going to be looking at the same level to place their stop. So you can kind of turn that around and use it to your advantage, sort of when reverse psychology comes into play. There's different schools of thought out there. Is it good? I like to throw it in there once in a while too, but you could end up twisting yourself up a little bit also, and maybe even taking yourself out of good trades that you should have been in. But for the most part, I like to look for where a lot of people are, where their pain thresholds are, and then I try and act on that too.
Yeah, it's a great point. Is, when you're looking at an obvious level like a support or resistance level, or even a simple moving average for an entry, think about how many other short time frame traders are entering there. Think about where their stops might be, and you might want to think about getting into that trade when those stops get hit, because when there's a pile of stops, the market seems to sniff those out. Some predatory algos will go look for those. And you may find yourself in a much better trade location and able to manage the risk even smaller. Another thing JD was saying is, if you're looking at 30 ticks on a stop, you'd better be looking at, much more of a profit than that. If you're looking at a stop that's 30 ticks and a profit target that's 30 ticks, why not see if you can't get into that trade a little bit closer to that point of invalidation? Maybe let's move that stop down. Let's move that entry 15 ticks closer to the stop, which expands our profit target and limits our risk.
John, I like what you said there. I struggle when someone says, okay, my profit's 30, my risk is 30. Okay, you're entering into the center of a range that you've defined this idea of a range because you have a reason to say your target's here and your stop is here, or vice versa. You have a reason behind that, and you're going to hop in right in the center. You're getting stuck in the center of a range, and if you do that too often, your probabilities of being successful in this are going to get diminished. If you can get closer to those points of risk, those points of invalidation, you have a better opportunity to increase that risk or increase that profit target, minimize that risk. And if you start doing that more often, when you do lose or have those losing trades, they're not going to affect you. It's not going to wipe out one big winner, right? A 30-tick win in most products is a pretty damn good winning trade.
Yeah.
And if you can start to minimize your risk on those trades, those winners are going to hold out over time. Something else I really wanted to touch on that JD said that I kind of jokingly called him the dancing bear and trying to short this melt up. If you are trying to fight those counter trends, JD said it really well. You better have extremely tight stops because it's a really difficult market to short when the market's trending higher, or flip side, if it's trending lower and you're trying to counter trend that and go long. Those are really difficult trades. And so you got to keep that risk tight so you can have some more opportunity if that's what you're trying to do.
Here's a suggestion. If you're trying to fight a directional market, your only stop should be to shut your computer off. Don't fight directional markets. This market's melting up. If you think you're going to pick the top, you're a much smarter person than I am. I can't do it. If you're going to try and fight a directional market, your stop is just turn it off.
And markets that tend to melt up or grind higher, it's always a difficult environment. And I see that, with our funded traders too. It's hard to be a buyer of new highs. You want to follow the trend, as a day trader, but if you're buying new highs, then, any little pullback could get you shaken out. This isn't really related to stops, but, in an environment where you are grinding higher, you don't really want to fight the trend and try and pick tops. Most people get cut up and lose small amounts of money a bunch of different times doing that. Keep an eye on the daily price action. Look at a daily chart and find yourself a buying opportunity if we're in an up market and the market sells off for a couple of days, maybe that, third day after a 2-day sell-off would be a low risk entry to try and catch a bid, catch a long in the direction of how the market's trending. So aside of that, I want to go back to something John mentioned about us all having different risk tolerances. Absolutely, we all do. Even people with a certain risk tolerance will also measure their risk on a per trade individual setup. You could have same individual might risk, 50 ticks on a trade, on one trade. Another trade they might risk 20 ticks on or 100 ticks on. I think that, what we were talking about, or what you guys were talking about, someone risks $100 to make $200 on every single trade. It's not a bad rule of thumb, but I don't think you're factoring in the situation there. It's basically you have a strategy that you risk 10 ticks to make 20 ticks. That's okay from a risk standpoint, but there should really be more interpretation on the trader's side as to, hey, if my risk is 2-to-1, what is this situation showing me? Could I risk 20 ticks to make 120 ticks? Those situations provide themselves every once in a while. So that's another thing to keep in mind. You don't need to always be fixed to risk 100 to make 200. Really try and interpret the markets a little bit deeper if that's the camp that you're in.
Totally agree, Mickey. The stop has to fit the situation. He was talking about having a static stop number for every trade you take. Not a good idea. Different market states are going to offer different risk parameters as well as different profit potentials. A more volatile market, you're probably going to have to risk a little bit more, but you got to remember, if you're right, the profit target is likely to be much greater as well in a volatile market. So always think about the stops in the context of the current market state, always.
Well said. I just want to shout out to everyone saying hello. Vlad, Nick, Oliver, a lot of talking about higher volatility. Got to be careful with those stops. And then Art's got a great question. I think it's a very hot topic when it comes to talking about stops. I know every single person in the world probably has a different viewpoint on this question. But how do you guys feel about trailing stops? I find that sometimes they cause you to leave money on the table.
They're an art form. And nobody is a master of them.
I like the concept of a trailing stop. It only makes sense that as a trade goes in your favor, you're taking a little risk off the table. It's great if you can get something to break even, but based on the market environment, you put a trade on for with the idea that it's going to go to a certain level, or if it goes to a certain level, it might continue on where you could peel some off and let some run. Never bad to take risk off the table, but depending on your time frame, you've got to give your trade some room to breathe. I can't tell you how many times I've seen other people, you bring a stop too close to where the market's trading, you don't give it enough room, you get stopped out, and then the market does what you were thinking it was doing. And it's kind of hard to say that there's a good line to walk when it comes to that. I personally like manually trailing stops, as opposed to for every 2 ticks my stop moves 1 tick. But that's personal preference, and there's no right or wrong answer. I mean, you want to manage your risk. That's what you're there to do. At the same time, you want to let the market do what it's doing, unless you see something new happen that changes your opinion on the direction. At what point it might make sense to just exit the trade immediately, or move that trailing stop or that stop even tighter, because you don't want to give it, once you feel differently about the direction of the trade, that's when you don't want to give it room. You want to, cut it off quickly.
That's great. Yeah. I think Mick, you said it, it's everyone has a different opinion, even though maybe they do things slightly similar. I have a hard time trailing a stop. Only will I trail a stop if I take one off and then I have that extra one to run. If I can have a runner go and I can lock in my profits with the one contract or cut down my size, then I can start to say, okay, I've locked in profits on this trade. At this point, I'm making good quality money no matter what. Now I can start to bring that stop up, trail it. I know there's indicators out there, all sorts of different things. Parabolic SAR is one of them that you can use for helping understand that trailing stop. But again, it's just time in the markets and learning how these things go. And the second something changes, you got to be quick to react.
Yeah, the probability of getting in on a trade immediately before the rip or whatever is very low. A trailing stop, I find those retests, you're always going to get taken out prematurely. So like Hogue said, I mean, I'll keep agreeing with Hogue, maybe trade multiple contracts and take a little off the table, let one ride. But I've never had much luck with trailing stops. I'll move them up manually if they go my way a little bit, but the trailer, no thanks.
The only time I found them to be highly useful is in highly directional markets like the S&Ps today. If you're in a trending market, a market that's going to trend all day long, the problem is most people are always going to put that stop just a little bit too close. The market always seems to be able to find that point where it's going to scare the longs to think that the market state is now broken, and it'll always go and find those. But as far as range bound trade, I don't see any reason to trail a stop. In trending trade, maybe it's something that I'll do, because, you know, if you think about it, you bought the S&Ps today, you were at the highs right now. We've got a really nice big profit there. You're going to protect some of that at some point. It is an art form. It is very difficult. Like, you know, Dan said, the parabolic SAR, check it in different time frames can be helpful. But again, it's an art form. And, you know, just like trading is an art form, you know, is anybody really a master of the art form? It's a good question. Another last thing I wanted to mention was Mick was talking about using stop markets. You should always use stop markets. Stop same limit. You may not get taken out of your position if there's more stops at that level that are in before you, and there's not enough bids or offers to absorb those stops. It'll leave you in the market and leave you just out in the wind. So just make sure that you're using stop markets. It may cost you a couple of ticks, but at least you're out.
Yeah, you definitely want the guarantee of getting out more so than the guarantee of the price that you get out. I mean, it's not just stops that could leave you in the dust too. Someone comes in with a big market order, and you know they chew up all the bids or all the offers that you needed to buy or sell into for that stop. You're caught in the wind. It's not a good place to be. Not what you want to wake up to if you left something on overnight. I don't mean to get too wordy here, but we started talking about stops today because last week when we were doing our segment on something else, we kind of got into stops. And since we're doing a stop featured segment here, thought it would be important to kind of circle back to a couple things that we talked about as far as where people place stops. You know, I mentioned and we discussed last week that you kind of can have an idea of where people are placing their stops on any given trading session. A lot of people place stops above the previous day's high or below the previous day's low. If there's any range expansion and it's going against them, range expansion being taken out previous day's high or previous day's low, there's going to be some stops there. On an intraday basis, you know, people look at the opening range. I go long during the opening range. I want to see continuation to the upside. If we break the low or have range expansion from the opening range, I don't want to be in that trade anymore because there's a chance we break out to the downside. So longs will have stops below the opening range. Shorts will have stops above the opening range. And, you know, you can also look at swing highs and swing lows. People will place stops, you know, where swing highs and swing lows are too. It's a range expansion thing. So these are all things that you can interpret or think for yourself, because people will know that there are stops there and they can, you know, make plays in order to capitalize on that knowledge. Another thing, it was brought up last week that, you know, some people feel like they put a trade on and immediately they get stopped out and then the market goes in their favor. And that kind of goes back to us talking about this market melting up or grinding higher. You know, anytime you're going to be a buyer of new highs and the market pulls back, you know, if you're doing short-term trading and you don't have a wide stop, you're likely going to get taken out, where in many cases you should be putting on a lower risk trade there. You know, go long on a pullback, don't get stopped out of a long on a pullback, sort of thing.
Awesome. Well, guys, as always, any questions you guys have, feel free to drop them in the comments. I'm always taking a look at them, trying to bring them back into the playbook here. I think on that note, I'm going to bring us a quote that I really, really liked. It has, I don't know who actually said it. It says unknown, but safety doesn't happen by accident. You don't accidentally place a stop and save your entire account. You've got to be thought about it. You've got to think things through, and you always have to be safe when trading.
Love it.
All right, Hogue, you want to sign us out of here?
Sure. Hey, S&Ps are currently working in and around weekly kickoff high right now. might be an opportunity for you. Get out there and profit, trade well. We'll